Stablecoins are the backbone of digital payments, and soon companies like Amazon, Google, and Apple might be issuing their own. Meanwhile, firms like Ondo Finance are tokenizing US treasuries. So what does this mean for the future of money? In this video, we're going to run down the definition of stablecoins, how they work, what's backing them, their history, and market trends moving forward. All right, so what is a stablecoin? A stablecoin is a cryptocurrency designed to maintain a stable value. Typically, these are pegged to fiat currencies like the US dollar. Many of you may know Tether. What they do is they reduce volatility and enable fast transactions to move in and out of trades in a seamless way instead of having to go back to fiat currency. It's a representation of fiat currency as a crypto, basically. And they're pegged. So how do they work? Well, they should be backed one-to-one, according to the U.S. government in the regulation that they're rolling out, by cash or cash equivalents. So USDC and RLUSD have basically blazed the trail on this. Tether, not so much, and we'll get into that. But they cannot be crypto-backed in the regulation that's been proposed here in the U.S. In the past, there have been a couple other models, and this is kind of the history of stablecoins, where maybe they've been over-collateralized by other things. So Bitcoin has been used by Tether to back their cryptocurrency or their stablecoin more prominently in the past, and then reduced that on their balance sheet in the most recent years. You've got DAI, which is an over-collateralized stablecoin. And then you had algorithmic stablecoins like UST. Obviously, that was a blunder and didn't end up going very well when it all fell apart. They were paying 20% interest. It obviously wasn't sustainable. But there are many stablecoins that do pay some type of interest, and we'll get into that as well. So they're used in transactions and mostly just payments between counterparties. They can move 365, 24/7. They don't need an intermediary like a bank to be able to settle the payment between people. Most of the time they go from exchange to exchange, right? So let's say I wanted to close a transaction for a home on a weekend. I could do that with a stablecoin. Whereas if I have to wait for my bank to send that payment or deal with the escrow or their clearinghouse, or there's lots of things where there's intermediaries that currently cause a lot of frictions and take a lot of payment or fees for providing these payment services. Whereas with stablecoins, as long as you trust the counterparty that's issued the stablecoin, that it is backed one-to-one, you can move that money anytime you would like. And that's one of the main benefits of all of these financial products moving on chain, is the ease of transfer between them on a 365, 24/7 basis. Let's get into what actually backs the stable coins and